Let's get a quick audio and video check in. All right, I figured I'd do another live premium video cut. A lot of questions, and I figure what we'll do is we'll record the premium video and then I'll hang out and we'll do some extra Q&A on some markets you might want to take a look at. All right, all good? Excellent. Okay, so let me give you a list of what I had in mind, and then you guys let me know if that list covers what you wanted to take a look at. Okay, so let me know. Okay, I've got on my, I hate the news. Oh, Glenn, I'm with you. So crude, we're going to talk about crude. We're going to talk about RBOB. We will talk about relatedly USO, UGA, and XLE. We'll talk about those as well as XOP relatedly. Okay. I've got gold. I've got bonds on the agenda and copper. We did send out a copper alert, by the way. We'll talk about the morning day trades. And, we're going to talk a little bit about end of day versus intraday, because I think that conversation has to be had. And then we'll talk about US dollar versus Australian dollar, US dollar versus Canadian dollar, British pound. And I get a lot of questions about the euro, so we'll talk about that as well. So anything there that I missed? I've been working all day. Heard I missed a very entertaining morning session. Mark H 2.0. I don't know if just listening to me try to fight back the curse words was entertaining, then yeah, probably so. Yeah, entertaining. Yeah, more shenanigans. Right, definitely shenanigans. Lots and lots of shenanigans today. Lumber? Oh, okay. Yeah, sure. Actually, I'll take a look at that right now. I'll take a look at lumber right now to make sure that it's something. Yeah, let's see what we got there. That's interesting, lumber. Okay, so dramatic swig of raspberry goji rose kombucha. It's really good. Okay. Lumber, yeah, let's take a look at lumber. Lumber is pretty thin, Law. And I know you know that. I know you've been with us a while. Lumber is exceedingly thin. And I'm not even sure what contract month we're in for lumber. Lumber is LB. Yeah, I'm not even sure. What was there a particular contract month you were looking at? Yeah, it's a horrid chart. Yeah, it's very, very illiquid. It's very, very illiquid. Hey, hey, Mark. Oh, it's Oh, that's kind of our inside joke. So, gang, yeah, Mark for Rabbit Foot. How you doing? How you doing, Mark? Oh man, that's so the first time I played poker, and I mean the very first time I played poker at the now rescheduled, we by the way, we did reschedule the simpler mentorship. And the very first time I played poker, Mark was sitting next to me, right, Mark? And I think we made it to the final two. I made it to the final two, and I told Mark he was my lucky rabbit's foot. How you doing, my friend? Haven't seen you in a while. Hope all is well. Lean Hogs moved down today. Yes, great. It was a memorable time. I had a blast that day. That was a good time, Mark. Yeah, that was a really good time. All right. So, yeah, I wouldn't let you leave. Yeah, you were my lucky. Yeah, until I realized that I was playing we were playing a member. So it was me against a member. And then like, well, even if you win, Rog, we're going to give everything to the member. And I remember being slightly disheartened because I am probably one of the most competitive humans. Well, I know. And I know some really competitive humans. And yeah, as soon as they said, well, you can't really win, I remember like, okay, what's come the point? So yeah, I had a good time. You definitely made being the first loser a whole lot more fun, my friend. Oh my gosh. All right, so let's get to it. Hogs moved down today. Yeah, that's the ag trade. So if you guys want me to review that ag trade, I am more than happy to do that. Okay. Hey there, B-Car. Raghi, I have found that when I am much better when I trade either two accounts as well as two correlated futures, such as ESYM, ZNZB, doing quite well. Would you comment on this? B-Car, that gives me a little bit of an idea of what you're doing, but not probably enough to be helpful. So I'm happy to have a discussion, but maybe send me an email, Raghi@simplertrading.com, first name at simplertrading.com, and I'm happy to take a look. No, it sounds interesting. Yeah, send me something over. But look, if it's working well, before you even send the email, B-Car, this applies to everybody. If it's working well, you're going to hear me say the word process probably enough to make you nauseous and sick of me saying the word process. But it is all about capital Y, your capital P process, right? It's all about your process. Now, for me, my process is going to focus on trends. My process is going to focus on understanding the structure of the market. That's going to include, I like the word causation over correlation. I like currencies, right? What else do I like? I like commodities correlating to bigger narratives. I like trends, all right? I like trends for sure. We like looking at exhaustion. So these are some of the broader things that make up my structure, my trade structure, my market structure. And that process that involves those really minimally 5 things, I'll refer to again and again. So when I say something lacks structure, it's defying what normally happens in those situations. Okay? So I'll always say, do you have a step-by-step structure-based approach? And again, this comes from, for me, this is something that was taught to me in the late 90s by my macro mentor. My macro, and when we say macro, we mean macroeconomics, not broad picture narrative, thinky feely stuff, right? And I got really lucky. He was at the global investment desk. He was part of the global investment team at Merrill. And I got to tell you, I think Merrill, and you could even say RLM, were at the forefront of a lot of the macroeconomic processes that we see today. And so my 4-stage approach that I use for Forex, but of course for equities and commodities, my 4-stage approach to macroeconomics comes from that mindset, this 4-stage measurement of inflation, GDP, right? And we'll get into this at some point. It definitely applies to currency trading, but inflation, GDP, money supply, and monetary policy. And really what a lot of traders try to do, especially in the currency side of things, is they try to front run central banks. Central banks typically are slow moving, like tectonic plates, slow moving things. So if we can front run what they're going to do based on an understanding, all right? This is not new. This is not individual to me. This is something that almost every good macro a practitioner that I know follows. They might come from a slightly different school of thought, but I'll tell you right now, most of what you're seeing as macro was developed in the late 80s. It got popularized in the mid to late 90s. That's when I learned about it. And RLAM and Merrill Lynch, to me, were really at the forefront of that. So just, something to put out there as well. So just so you guys know what I mean by process and step by step. Okay, I'm kind of wandering off the reservation here a little bit. So let's get to it, all right? I've got the list. All right, let's do this. Okay, so let's start off with crude, because crude really was what upset the apple cart today. So let me get the recording going. Feel free to ask any questions that you may have, and I'll be happy to make some time for Q&A. All right. So let's start off with crude. All right. So we're going to kick off this conversation with a look at crude oil, because crude oil was very much the catalyst for a lot of the price action that we saw today in the equity indices. And the reason for that is, remember, the market is always bouncing two ideas around: known versus unknown. Known versus unknown. What was unknown today? What the initial claims number would be. What was known? That the initial claims number would be released. What was known today? That we knew the initial claims number was another record 6.6 million as opposed to 3.2 that we got last week. What was unknown is that we would get the president calling up CNBC to mention that he had been on the phone with Putin and that Putin had been on the phone with MBS. And punchline, he said, we're expecting a 10 to 15 million barrel per day production cut. Boom, that sent crude oil higher. Now, for those of you that were in the room with me, probably a lot of you remember Salty Raghi coming out and saying, what the heck? Not but just yesterday were we talking about a market that rallied when the buildup was higher. In other words, when we had a inventory build in crude. Well, that kind of made sense. I had to let go the irrationality of that, but that kind of made sense, because not but a few days ago, the general public, the U.S. public, was told, hey, that price you're paying at the pump due to historic production, due to that production making its way to refineries, giving you at the pump very low prices in crude, was akin to a tax cut. All right, well, I can understand that. I can get behind that. And then what happened is, when we had the build, people thought, great, even lower prices in crude and even lower prices in RBOB, which is the RB futures contract. Now, I'm even more bearish RB, or the UGA ETF. I'm even more bearish that than I am crude, because all the overproduction, let's call it what it is, all the overproduction in crude is going to be peddled off to refineries. Refineries are going to be making unleaded at breakneck speed, and that unleaded is going to find its way to us at the pump. It's going to find its way to, crude is the king of commodities. There is not a single commodity out there that at some stage of its planting, harvesting, growth, transportation doesn't involve petrol, right? There's no such thing as any commodity that somehow completely circumvents. And I mean commodity as in the grocery store to the world, not the financial instruments, not the currencies, not those things. I'm talking your grains and your softs and your meats, etc., right? Your grocery store commodities. Nothing can work around the fact that at some stage, the machinery that either moves it, harvests it, plants it, transports it, is going to require crude oil, right? Okay, so that's why I call it the king of commodities. The king of commodities simultaneously is under pressure in three ways, really. A planned and expected drop in demand that we were warned about throughout 2019. Clearly, right, the coronavirus, and a very strong U.S. dollar. Strong dollar typically means weak commodities. So that's another sort of force keeping pressure on commodities. All right. So what do I want to do with crude? Now, I don't ever want to confuse politics with trading. Stan Druckenmiller talked quite a bit about how many of his peers, and we're talking people moving around billions of dollars, how many of his peers got caught up in the politics of 2016, who was in the White House and what it meant, and they forgot how to play the market. They got very emotionally tied up. And that reminded me of something I've always known. Don't get caught up in the emotion of politics. It doesn't pay. Unless you're a political pundit on one of the cable networks, you're not going to get paid for your opinion. And I'm going to tell you something right now. Nobody cares. Not about mine, not about yours. The market certainly doesn't care either, right? So having said that, I'm going to put something else out there, right? Not to tick anybody off. I could care less about the politics of it. But we know that, well, our president is prone to some hyperbole and some supposition. Let's use that word. He is prone to that. This is not news to anybody. So the crude oil market rallies up on the expectation that this conversation is in fact, well, something that led the president to believe that a 10 to 15 million barrel cut was really in the works. And the market responded to that. Okay? Responded to that supposition. It was just a logical, to the speaker's mind, it was a logical flow of where the oil production was going to go. And then almost magically, the market just remembered exactly what I just told you guys and said, wait a minute, let's think about the source here. And the fact that, again, I'm not here to talk politics. And what I'm here to say is there's a kind of natural expectation right now when certain political leaders speak. I guess we could chalk that up to all of them, right? I'm not picking on any one. And all of a sudden we said, well, is Putin really going to do it? Is MBS really committed? And did our president really hear it right? And then boom, you saw the pullback. I think if we get confirmation of this 10 to 15 million barrel production cut, if we get it, and we're already hearing that OPEC, the Saudis want to, and this is where some of this is factually probably starting, the Saudis want an emergency meeting. We have one more thing, one more hurdle that we have to get through, and that is let's get the official number. Let's get the official agreement of who's on board. Is the U.S. shale, is the U.S. shale producers, which, by the way, are the ones that are overproducing the most, okay? They have to. You have to produce a lot of crude when your cost per barrel is extremely high, and that's where shale is. Shale is the most vulnerable. Next most vulnerable are the Saudis, least vulnerable are the Russians. So if we get one more spike higher, gang, this is where we as traders, we let go of all the chit chat, all the narrative and say, less demand. Production cuts are not demand. Less demand, let's short the 21 exponential moving average. Okay? Now, it's probably a really long story for me to tell you that we want to short the 21 exponential moving average, but you have to kind of know why, because the timing of all these players is going to likely be what will sort of dovetail with the technicals. Okay? So again, I'm not here to turn anybody off. I could care less about politics. What I am here to acknowledge is that there are certain people that are going to move the market. We saw that clearly here today. Okay. So then today's crude oil production cut expectation also took the equities markets higher. Now, in just yesterday's premium video, I said, look, if you did not get your short at the 21 exponential moving average prop dot, 21 EMA prop dot on ES, if you did not get your short on the 21 EMA prop dot on the YM, if you did not get your short on the NQ at the wave, I don't think those opportunities are necessarily done. And how come I can't pull up YM? Let's try this again. Incorrect symbol. That's not true. Okay, hang on one sec. Every now and then I get a chart that kind of corrupts. This hasn't happened in a while. But let's see. Copy window. Close. Give me one sec. Let's see if I can get it to work. Okay, give me one moment here, gang. Every now and then it's a kooky little thing that does happen. It's a funky little trade station thing. And actually, And actually, while I'm trying to put this chart together, it probably would behoove me to tell you guys a little bit more about what's on it. So let's do that for just a moment as I'm sort of putting this back together again. Hopefully it's, all right, there we go. All right, what do I have on this chart? So let me show you here. What am I running on it? I want to run the propulsion dots, the grab, the wave. These are free tools within the TradeStation Trading App Store. They're free tools that I make available by way of the Think scripts for Thinkorswim. These are free tools within TradingView. The tools that are not free are the squeeze and the, let me add them here so you can see them. The squeeze is not free. There we go. The V profile and the V score are not free, and the VWAP is not. Another question that I get is, Rock, how do you do that overlapping thing with the squeeze? I modify the squeeze, by the way, just to give me the dots. And then what you can do is put it in you can share the subgraph. You can share the subgraph. So you put them in the same subgraph and boom, you end up with this sort of combination of the V squeeze, if you will. All right, for those of you that use the squeeze and the V score, that way you're not taking up valuable real estate at the bottom of your screen. Okay, so let's get on back to crude. We talked about that. Hopefully it's loading up well. Okay, so the 21 exponential, by the way, crude oil is a 21 exponential prop dot short. The S&P is a 21 exponential prop dot short. The Dow, the YM, is a 21 exponential prop dot short. Now, for those who are saying, Rog, I'm new, what the heck's a prop dot? This is the simpler trading propulsion. Think of it, and this is a unique tool. This is a tool that replaces nearly all the exponential moving averages on my chart. It's free. It's free for TOS. It's free for TradeStation. It's free on TradingView. I think we have versions of it that are floating around in Ninja. I don't use Ninja. We have versions of it on, I believe, the AT charts through Infinity as well as the Sierra. Okay, so this is a free tool. I've made this free since I taught the class back in 2017, I believe it was, or 16 even. Anyway, what this is a measurement of two exponential moving averages. It's taking a moving average cross, the 8 diving through the 21, and it's plotting where the longer of the two moving averages would be. So if you had a 21 EMA on your chart, you only want it to turn on in a trending environment. You really only want it to turn on when it's interacting with price in a what I feel a predictable and useful way. So this is what simpler propulsion does. It takes into advantage that very classic moving average cross, a short moving average diving down through a longer one, and then it replaces the moving average with kind of what I consider to be a smart or auto-correcting, self-correcting EMA. It's very cool. Give it a whirl. That's where I'm looking to enter this trade at the 21 exponential. Now, on the Dow, that 21 EMA has stopped plotting. So it's probably going to make sense for me to also consider the 34 EMA on the low, which is exactly also where the NASDAQ short will fire off. Now, some of these longer term setups, whether that be the NASDAQ, the S&P, the Dow, copper, gold, these are setups that I have and will continue to send out as alerts. Yes, I want to alert you guys when I do it, but even more so than that, it's really important to me that I alert these things sometimes hours, if not days in advance, so you have this on your watch list. You're well familiar with the charts. You're very familiar with the setup. And then when it happens, it isn't like something like a knee-jerk reaction where you're scrambling to get into the trade. You're able to calmly, collectively say, yeah, I knew this was coming, and I know exactly what my reaction level is. When it fires off, I've got an alert waiting there, and I know what I need to do. I've decided to either trade the option. I've decided to trade a micro. I've decided to trade a mini, what have you, at that level. So I never want you guys sort of knee-jerk trading. I like to give you all as much heads up as possible because that's when you get to make the alert a study and you learn something from it so it too can become a repeating process for you. Okay? So copper's out there, 21 exponential. Dow's out there, 34 EMA on the high. NASDAQ is out there also as another short, 34 EMA. So did I say on the high, 34 EMA on the low, the red line. So when you don't have the dots, so we have the dots on the S&P. I believe we still do. Let me double check. Oh, we might have just lost them too. When you don't have the dots, what does that tell you? The 21 EMA is shut off. So we probably need to focus on 2648, 2650 for the ES. Some of you say, Rod, can we really get up there? Let me ask you something. Does this market want to rally? I'm not sure that it wants to rally, but I sure know that it's being coaxed. It's being convinced that it's not time to sell off yet. So we focus on the top and bottom of the range. Very important distinction with the way that I trade. Our shorts are up here. They are not, I repeat, they are not down here. Okay? So we want to focus on the top, what I call the top of the range. I know this is not a unique name, but that's what it is. It's the top of the range. This is pure support and resistance, gang. What is support? What is resistance? All right? So let's do this. This is resistance. This is support. This is the top. This is the bottom. That's simple. Right? So we look at the ranges and we say, where do we have an advantage to being short? Where's my best risk reward? Up at the top of the range. Where do I have the best opportunity for a buy? Quite frankly, gang, I think that buy is probably pretty consistently right now at the bottom part of the range. All right. So until that low here around 24.26 gets taken out, until we can start running stops really through 24.20, very unlikely that the bears are going to be in control. Very unlikely. So that's something else I want to, make sure I'm really emphasizing here. So I sent out some alerts for gold. I sent some out alerts for copper. Gold took off. It did, and we were looking for 1575 yesterday for the trigger in order to buy GLD. Am I going to do it again? Absolutely. There are two zones for us as a trigger to buy GLD. And one of the things that I want to do tomorrow with you all into the close is talk about these contingent order type placements that specifically you can do in Thinkorswim. Most of our membership is in Thinkorswim. So I'll talk about how to place that kind of option on Thinkorswim. All right. Okay. So next is looking at so you talked about copper, we talked about gold. A lot of questions about bonds. Do I want to be long bonds? Does anyone here think interest rates are going to go up anytime soon? The only thing that I'm lacking on the bonds, whether that be the 30-year, whether that be the 10-year, whether that be the 5, what I'm lacking is a pullback. We need a pullback. Is the Federal Reserve buying all ends of the yield curve? Yes, it isn't just a longer end any longer. They're trying to also keep the yield. I mean, they were doing this a while back. They figured, well, if we buy across the entire yield curve, we can sort of eliminate the inversion, right? And they're trying to do that, but too late. It's already double inverted. A single inverted yield curve is not a high predictor of recession. It's the retest. We talk about retests a lot, don't we? It's the retest of the yield curve that's actually the trigger for the recession. And even then, if you want to look at it, subsequent trigger for weakness. And we did have that re-trigger, that retest. So they can do whatever they want across the yield curve. We're quickly heading to where the U.S. government is going to be the largest holder of treasuries, of U.S. treasuries, just like the Japanese government is the largest holder of Japanese government bonds. So they own the most JGBs. Look, we're heading in the same direction. You might ask, where does that actually eventually go? I think gold is the beneficiary of that. If you kind of take that narrative from a macroeconomic perspective and look at the dominoes falling, I think the winner, longer term, of course, but longer term, the winner does end up being gold. I do believe that. So we're long dollars, we're long bonds, and we're going to continue to look for opportunities to get long gold. Not a new narrative for us at all. In the meanwhile, our long dollar play against the Australian dollar, and our long dollar play against the British pound are both pretty much on track. The British pound has taken its time. It's spinning its wheels here, but it's spinning its wheels below our entry. Look, I don't mind a lethargic P&L, but it's a whole lot easier to sit through when it's green than when it's red, right? So Australian dollar has been terrific. Sell Aussie, buy US dollars. The question then becomes, well, why not euro, Raghi? For a couple weeks now, and I know those of you that are with me, yeah, this is going to move from time to time. But how many traders did this thing punish when the dollar weakened? So one of the things we have to remember is the trends in the dollar's strength are right now playing out better against the Australian dollar, New Zealand dollar, Canadian dollar, and pound. Yes, there will be certain days that will look great for the euro, but we're better off right now day trading that until the euro US comes up with better structure. And that brings us another related topic. That brings up, can we short Canadian dollar? If the Canadian dollar is going to strengthen with this crude oil narrative, I do want to take advantage of the Canadian dollar going up with this high tide of crude oil. And then the same time that I'm likely going to be looking at a CL short, we'll take a look at a 6C short. We'll short that Canadian dollar against the US dollar. That's another narrative that I absolutely want to take advantage of and add this in a more meaningful way to our short in terms of against the dollar specifically. All right, so crude oil, RBOB gas, and the Canadian dollar are all in the same wavelength. And we can add to that the EWC. So if EWC heads up to the 21 EMA prompt dot, like we talked about there, we're going to take a look, and we discussed today the 22 strike puts on the June contract. The 22 strike puts. It's the second largest, I believe, on the options chain. The first largest is the 24. 24 strikes have 9,000 open interest. 22 strikes have 5,000. I want to take advantage, and they're very inexpensive. For those of you wondering, Rob, how expensive is this? It's actually very inexpensive. We're talking about $1.85 to $3.30 options. And I'm purposely talking about the bid on this because the bid is the side of the market that we're most interested in. We want to enter these puts with bullish momentum, and we're going to have a much easier time getting a fill at or closer to the side of the spread at the bid. There is right now a, 60-cent spread. Am I going to pay up and pay the ask at 245? Heck no. I'll sit in down at 185, 190, 195, $2. That's fine. Edge towards the side of the bid, and you will get that fill more often than not when the momentum is going up and you want to buy a put. All right? When you want to buy a put. So when we're talking about intraday versus end of day trades, we're going to wrap up our conversation here, gang. End of day versus intraday trades. When it's a daily time frame or a non-day trade, when it's a day trade, I'll put in day trade, and those are just good for the day. Just let those cancel. But if it's not a day trade, I will put the trades in good till cancel. I will do GTC. And we'll do some special breakout sessions on order entry here going forward, because I know a lot of new traders are interested in, okay, Rod, I don't quite understand what you mean by the bid-ask spread on the options. I don't quite know when I should be end of day versus good till cancel. And we'll do that throughout the month of April for sure. All right, so this has gone on a little bit longer in terms of a premium video, but I know a lot of you have a lot of questions, and I hope this absolutely helped. So that's going to round out our premium video, and I'll see you in the next update. All right, so let me those of you that stuck around, let's tackle some Q&A, and then we'll call it a day, okay? So questions. May I know the strike price again? Of course, 22, SH 22 on the strike. When I receive the alerts, yeah, that's a great question, MC. If they're day trades, they're just for today. If they're daily time frame trades, they're good till cancel. And here's the great part. Day trades, I will also always say, is a day trade. That means everything else is on the daily time frame. And I don't any longer look at 8 time frames, 6 time frames. I'm looking at basically one longer term and one shorter term. I'm either looking at a daily in a 1 or a daily in a 5 or 15, and that's the Forex side. So I've got 1, maybe 2 on the Forex side, intraday, end of day, and then on the equity side and equity indices, it's 1 minute, daily. Everything else in between, I let go because it's hard enough to find a trade. And then we add to that the sort of unrealistic nature of, well, the 30 is better than the 60, or the 60 is better than the 180, or the 180 is better than the 5. I don't play that game any longer. You guys remember In Living Color? Homie, don't play that. Homie, don't play that. All right. What other questions you guys have for me? I know it's been an exhausting day, but I hope you guys have been enjoying these live videos so we can ask some questions and we can, sort of round the day out with tackling things that might be puzzling and perplexing and even irritating right now. Bond yields are going down negative. Why is the price going up? Oh, okay. So Steadyman, when you look at the direction of interest rate instruments, meaning euro dollar or bonds, the direction of the chart, and I think this is what you're asking, so correct me if I'm wrong, the direction of the chart is inverse to the interest rate. So let's put it another way. Oh, did I just delete that video? Oh, that would be bad. Did I just do that? Oh, no. Whew, I thought I deleted the video. Okay. So look at it this way. There's a arithmetic to this. So think of 100, not as the limit, because certainly bond yields can go negative, as we well know. But think of 100 representing 0 on any interest rate instrument, meaning contract. So there's 100, which means 0%. Okay? So the closer we get to 100, the closer we're getting to 0%. So the direction of the market is inverse to the yield. Does that make sense? So you buy them, right? That's the way it's, so yeah, same thing with Fed fund futures, same thing with euro dollar, same thing with bonds. So kind of imagine it that way. It's really easy to envision with the euro dollar. But yeah, the higher the number, the lower the yield. So if someone says I'm long bonds, what they're typically going to tell you is they're long the instrument that allows them to take advantage of the movement higher, which is in fact a lower interest rate. I know, just to make something more confusing, right? It is not directional. It's actually inverse to the direction of the interest rate. Yeah, steady man, makes sense? Okay, cool. Next is, do I enter daily time frame trades in the afternoon since I call them end of day? So Nick, great question. What I do is I have a price. So accompanying these alerts is going to be either a trigger price or a zone. I frankly don't care when it's, for the most part, don't care when it's reached. I just need that price. And when it comes to options, I will additionally require the momentum. So I need price and I need momentum. Does that make sense? So no, I will typically look at end of day charts, charts like the daily, end of day or daily at the end of the day or after 11. But once I've got the trade idea and I've got the zone, I leave it good till cancel and I just leave it out there till it's filled or until I have to adjust the zone. Does that make sense, Nick? Awesome. No, of course. USO versus, Max asked, when we do day trades, we just take signals off the V-score and ignore the trade flags. No, not at all. But Max, normally what worked through March was fading overbought and oversold zones based on the V-score. That worked all through March. And actually some of February too. Playing trends did not work as well through March. Now, we do have different things that we do for initial balance breakouts and clearing range breakouts, which are a little bit more sensitive to the structure, above or below the grab, above or below the VWAPs, things like that. But right now, I'm still looking for fades. And by and large, I believe that's still the tactic to use. But the level at which, and you've seen it now, I'm not saying anything you guys haven't noticed. Now for 2 sessions in a row, I've dealt with, I'm using the word elastic, right? Rather than using any vulgarity. Okay. But they're very elastic. They're super elastic. And what looks to be a trade that would make sense from a particular standpoint is uncanny how we tend to get suddenly some kind of news, and then it stretches way beyond what technically, from a technical charting perspective, we should have stopped at. And then yet, directionally, we end up usually being proven right. But it doesn't matter, because if it takes the scenic route, the trade basically ends up in sort of this no man's land of uncharted territory that I no longer feel I have a map on. So I have got to bail. I've got to bail. And that's happened 2 sessions now, usually triggered by news. I say news. It's not triggered by data, and it's unscheduled, and it's unknown. These are things that come out of nowhere. And so the market discounts it rapidly, and that makes our levels elastic, as I'm calling it. USO versus DIG. I really haven't looked at DIG. I'm not even sure how much liquidity is in DIG, to be quite frank. I have it traded DIG. Oh, it's an ultra. I usually steer clear of ultras, to be quite frank, but you can play DIG, sure, if you're comfortable with that. I typically don't, but I'll usually just go the crude oil futures route or the QM, right? QM is a mini crude that's 1/2 the size of the full size. So it's half the initial margin, half the point value, half the contract size, half the calories. Yeah. So I would say, if you want to control risk, QM would be a good alternative to CL. And if you want to go DIG, it's probably going to, Aloha Claire, it's probably going to align itself really well with whatever we're doing in crude. So if you want to use crude to trigger your DIG trade, and it's paying so I'm not going to talk about dividends unless I'm talking about a longer term position. Right? So I'm sort of juxtaposing 2 different ambitions here, my trading versus portfolio building. To your point, Claire, Aloha Claire, yeah, I hear you on that, but that's not going to play a role in my trade any more so than the carry interest plays a role in my Forex trading, right? But longer term, it's a different conversation. Sure. What moves TLT versus SHY? The associated bond yield. 1 to 3 year on the SHY. TLT is the 22 to 28 year. Okay. Next up, thank you for adding. Oh, okay. Well, yeah, day trade. So I'll always call it a day trade, MC. Yeah. EWC. Yeah, when we get up there, Tim, I'll be happy to send the alert out. But the strike is going to be 22. Yeah, the strike is going to be 22. And the trigger is going to be 22. So the strike and the trigger are one and the same here. Yeah. Okay, a couple more questions. We're going to call it an afternoon here, gang. Seems that breakouts are working in the AM. Soaring Eagle, I think since Friday, I concur. There's been a certain resurgence of the breakout trade. Now, again, when I go back and look, and I do a lot of study on the past performance of my trades. I plug them into the different platforms that I use to study them. And I'll look at I'll plug my trades in. I'll look at whatever they may or may not be doing. And I'll look at the metrics and find out what is and isn't working. So what I mean by that is through March, the fades, the V-score fades were working in the direction of the yen. Right now, the market is ignoring the broader risk appetite or risk aversion cues, bonds, yen, dolls, common sense, right? So I think, yes, there is a certain amount of euphoria to the upside that's working with breakouts because people are so achingly bullish. They just are really thinking this is a V narrative like they saw back in January, and they don't want to miss it. And there's just sort of this ache, and it's being promoted by the powers that be, whether that be financial entertainment media or whether that be political entertainment. It's definitely being promoted, and it's tough, so we're going to talk, Steve, to your point, we're going to talk more about using options at some of those levels because we did that through March. And then I think in the middle of March, things were working so sharply well, I just started using the underlying futures again. But I probably need to start being a bigger proponent again of using the underlying options. Yeah. Yeah. And I will tell you, PC, to your question, up days, don't take my word for it. Up days are still, always think about the market in terms of rate of change. Okay. And the up days still have less volume than the down days. Down days still have more volume. They absolutely do. Yeah, MC, I'm going to talk about those conditional order rules. Yeah, I'll be talking about that either Friday or Monday or whatnot. Yeah. Yeah. Okay. So tomorrow we've got non-farm payroll. Can we take advantage of the 5-minute breach? You know, I might, if I do, I'll let you guys know. I'll send out an alert. But if I do anything with non-farm payroll, maybe I'll get on the mic for a few minutes around 8:20 Eastern. If I do, I'll definitely let you guys know if we're going to look at anything at non-farm payroll ranges. Yeah, the 5-minute range. If I do, I'll let you guys know. Okay. But Neil, David, and I are in the room. So one of us is going to be, if not, at very least in the chat room. Okay. Do I watch FinBiz after hours? Less if I'm trading the Asian session. Yeah, sure. If I'm trading the Asian session, I will take a look at FinBiz after hours. Sure. But not now. It's 5:16. Between 4 and 7 p.m. Eastern, we have this lull. We have this doldrums in the market. So I wouldn't even pay attention until about 7, even 8. You'll notice that the clarity in terms of the currency lineup gets much sharper around 8 p.m. Eastern. Okay. FOMO Momo Bozo, I'll tell you what, I don't know, my friend. You know, if the numbers are absolutely horrible, should we just go long? Oh my gosh, it's very tempting to say yes. Oh gosh. FOMO Momo, so all of us have people that we tend to like talk to when we're at our wit's end. And one of the things that I've been just really irritated about is just the lack of the elastic levels being right eventually, but then the market's going so far past levels. And I'm super frustrated. Yeah, I have been frustrated. It's frustrated, but it doesn't shake my belief in my process. So to your point, on one hand, yeah, do we fade all awful data? And for those of you that are wondering, why is the fade of awful data working? It's the same rabbit hole psychology that we've talked about in the past. When bad data is so stinking bad, what it's doing right now is giving more support for the expectations for a fourth stimulus package. Well, here's the joke's on them. They better have a 44th ready because data is not going to look good for a while. We've got another quarter or two of lousy data. So what? They're going to put a stimulus package together every time the data is jarring. But I believe that's the rabbit hole where bad data is good. That's what's happening. And we talked about this before in the past, where good data is bad and bad data is good. And now it's just more exaggerated. Yeah, exactly. I think that's what's happening. Initial claims at 6.6 million, 6.6 or 6, whatever it is, 6 million plus. My gosh, 11 people, altogether 10 million almost people have filed for initial claims. That's a heartbreaking number. Yeah, that's a heartbreaking number. Okay, gang. Yeah, Steve, it's not strength. It's battle tested. You know, that's what it is. It's battle tested. All right, gang. Go get some rest. Thank you for all the questions. Thanks for sticking around. Thank you for wanting to learn how to do this. This is something you can do. And if you can handle this part of trading, my gosh, gang, I'm telling you, I've got 33 years trading, but 27 full-time. Okay. Since 1993. Although I was trading from my dorm room in like 1990, but 27 full-time. I'm going to tell you this right now. I haven't ever seen a market like this. Not like this. Nobody has. Nobody has. Right? We just haven't. 1998 doesn't compare. 08 doesn't compare. The Greek crisis in 2010 doesn't compare. The flash crashes don't compare. The tech bubble doesn't compare. But if you can manage your wits and stick to your process, there's no market you're not going to be able to trade. I know it doesn't feel positive now, but it really is. All right, gang. Enjoy the rest of your day. And Neil will be doing the open tomorrow. I will see you all for the midday update and for the tech session and for the close. I have 3 sessions with y'all tomorrow. Check out the schedule at the members dashboard within the Simpler Trading website. Thank you for being a part of the team, and I'll see y'all tomorrow. Be good to each other, gang.